Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
Thanks for being here today. It's October the 15th, 10:26 a.m. in Santa Cruz Mountains, California. I'm glad you came back. My goal here, to be very specific and clear about it, is to show you methodologies that work from the trading and investing standpoint in combination with cyclical or repetitive phenomena. The definition of cycles can vary from trader to trader, from investor to investor. I use a broader definition. Anything that is a pattern is, in my terminology, a cycle. So you can have the long-term cycles, which I've showed in the past. You can have shorter-term cycles, or as I showed in the past few sessions, seasonals. A seasonal is a cycle that occurs within the course of a year. Specific dates, specific lengths of time are my preference. So one of the things that I talked to you about recently is the Columbus Day seasonal, based on the pre-holiday behavior. I talked about a book, The Behavior of Prices on Wall Street by Art Merrill. Merrill was very keen on research, one of the few people who actually did research in the 1950s, and he studied the Dow Jones behavior all the way back to the late 1800s, not just in terms of trends and closing prices, but also in relation to things such as bank behavior, raising or lowering the discount rate, and what impact it had, if any, on the behavior of the Dow Jones. And one of his great discoveries, at least great in my mind, because it's made me a lot of money, is the pre-holiday behavior. And to review the pre-holiday behavior, let's talk about it in terms of Thanksgiving. Thanksgiving is the last Thursday of the month of November. And what Merrill said basically was this. On the day before a U.S. legal holiday, the market tends to close higher, the market being defined as, in his case, the Dow Jones. And you'll notice we're being very specific. We can look at cycles in general terms and say, oh yes, there's the 10-year cycle in the CPI. Or, oh yes, there's a 7-year cycle in the Japanese yen. But 7 years, plus or minus 10%, is a considerable amount of time. For my work, the work as a trader, or as an investor, I need to be more specific. I want to know everything I can. Exactly when to get in, exactly when to get out, and when I say exact, I even mean as exact as time of day. Now, some people may consider that to be a tall order, but if you actually do the research, that's where it's all about. The research is very important. So as a trader, using margin, needing to make specific time-based decisions for specific patterns, that's what I prefer. So you might call it applied cycles, or the application of specific cycles or patterns. So talking about the pre-holiday behavior, I noted a number of U.S. holidays. Example, the 4th of July, Thanksgiving, Memorial Day, Christmas, New Year's, Easter, and so forth. I rejected some from consideration, specifically because there was insufficient history, such as, such as the Martin Luther King birthday holiday, such as a couple of others that we have as holidays, but not completely legal U.S. holidays, so we don't consider them. However, I did point out specifically Columbus Day, which by all rights I should have called Indigenous Peoples Day, because that's been the rename, but it is a federal holiday. And what I stated was very specific based on the work of Merrill. Because the holiday came on the 14th, which was yesterday, Monday, even though the markets were open, the banking system was closed. So the behavior of the market would be this. Because the holiday is the 14th, you would buy on the close of trading the Thursday before, and get out on the close of trading Friday, since Friday was the day before the holiday. The question is, how did it turn out? The question is, what are the odds of success? What's the stop? What's the profit target? How do we actually implement the trade? I'm going to go to a chart and bring it up on the screen here. And I hope you guys are seeing my chart live. And go to this right over here. So now what we've got, looking at the chart right over here, this is the current. In fact, let me make this a little bit bigger for you so we can see it better. This is where we are today. So I'm going to put a green line there. So that's already happening. This was yesterday, the green line to the left. I'm going to remove this one over here so we don't get confused. We're only going to look at Columbus Day or Indigenous Peoples Day. The rule is very simple. Buy on the close of trading this day right over here. Get out on the close of trading this day over here. This day over here, the middle one, was Friday, and the one to the left was Thursday. It couldn't be more simple. It's so simple, even a computer can do it. So let's go this right here. So the chart we're looking at right now is the S&P futures. If you look at it in terms of dollars, I'm going to get what's called the dollar difference tool right over here and bring it over to the screen. And remember, don't think of this as a trading opportunity as much as it is a cyclical opportunity, because this is a repetitive pattern. In terms of dollars, we're talking about approximately this. So that would be the approximate dollars per futures contract in the S&P. Merrill's research was done on the Dow Jones, but it's equally transferable to the S&P because they are related very closely, correlated practically 95%. So here's a very easy trade. Did it encompass all of the details of my trading strategy? Setup, trigger, and follow through. The setup was the entry date. The trigger was the entry date. The target was the exit date the next day. Certainly, one could have used a profit maximizing strategy to take advantage of what happened yesterday. That's not a problem. That's part of trading application, part of the trailing stop procedure, which we won't cover in these sessions necessarily, unless I see a particular need to. But in all rights, the trade worked, it was absolutely reliable, and the question is this: what did we know about the trade before we took it? Think about this in terms of what you're doing with your methodology. Do you know when to get in, exactly by time of day, by date? Do you know exactly when to get out? Do you know what risk would be involved in making the trade? Do you know what the profit target might be before the exit? I have a simple rule. I go 10 days previous. So example, this was the exit, the holiday right here. This was the exit date. This was the entry date. From the entry date, I go back 10 days. 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. Within this range of 10 days, I find the largest range bar, which is this one here. It has the largest range. I assume, for all intents and purposes, that that will be my risk. If I'm not okay with that risk, the trade's not for me. If the trade's not for me, I take advantage of it by using an option. A 0-day option, in other words, an option with 1 day left on it, would be very simple and cheap and allow you to participate in this trade very effectively, because the rule is what it is. I'm not even going to look at the market during the day. I'm going to just simply execute automatically at the end of the day as a buy and get out at the end of the day as a sell the next day. A very simple strategy. Let's take a look at the same trade, the same configuration on the Dow Jones. So let me bring that chart up. Here it is. So here's the YM. This was the holiday right over here. One moment, please. Holiday right here. This was the entry date, Thursday. And this was the exit date, Friday. And the amount of dollar difference was, again, This is a YM Dow Jones Futures. So let's bring it up on the screen, like so. And you'll notice the difference between what I like to do and what many other people do is I'm not estimating anything. I'm using specifics, dollar amounts, exact entries, exact exits, and so forth to be perfectly clear about it. So this was the move in the Dow Jones. I hasten to add here, it will not always be this easy. It will not always be this perfect, but it will have high probability because we measured the amount of probability over the course of many, many years. Let's go to another one. Look at the NASDAQ. So here's the NASDAQ. One moment, please. Here we go. So that's the NASDAQ. So here we go. This was the holiday, right here. This was Friday. This was Thursday. And you'll notice the difference. The NASDAQ did not do that well in comparison. Let me show you what I mean. So we're not talking very much money here, but nonetheless, the fact of the matter is, it worked. So, the real issue is this. Will you do it next year, or will you find an excuse? We can't separate the psychological from the factual. But the reason for not doing this trade in the mind of many traders would be this. It's going to be a weekend. The 14th falls on Monday. The international situation geopolitically is unstable. We are supposedly at the brink of a nuclear war. Who knows what's going to happen? Why take the risk, and so forth? Those are, in my view, simply excuses, because when you're dealing with high probability statistics, you follow the statistics. There's a way to decrease the risk, as I said before, by using an option, because you know that your risk on a long option would be the cost of the option plus commission, and that's all there is to it. So you know your risk before you get into the trade. So I want to thank those people who did send me emails and thank me for this trade, but now they want the next one. So what's going to be the next one? The next one is going to be Thanksgiving. The Thanksgiving rule is very simple. Thanksgiving in the United States always falls on a Thursday, the last Thursday of the month. And by the way, this does not apply to Canadian Thanksgiving, which was just a few days ago. Maybe yesterday, I can't remember. So, the question is, what are we going to do? Since Thanksgiving falls on a Thursday, the rule would be to buy on the close of trading Tuesday, get out on the close of trading Wednesday. Very, very simple. Let's look back in time. So don't get dizzy. I'm going to go back in time. I'm going to go back to the 28th of November last year, which was the Thanksgiving Day trade. Let's see how it worked out. Thursday, November 23rd of last year. So that was the Thanksgiving Day. You notice the range was very narrow because the market only traded half a day. The rule, very simple. Buy on the close of trading this day, get out on the close of trading this day. It couldn't be easier. It couldn't be more specific. And in addition to that, remember, you're going to go back and find the largest range bar of the previous 10. That would be your maximum risk on a futures contract. But you can mitigate that risk by trading an option. So let's determine the money. That's the key part of this whole thing right over here. Did it make money? Well, of course, assuming perfect execution, it made money. But you have to follow the rules. And how much money did it make? Not bad for an overnight trade. About $825 on the futures contract. That was in 23. Let's go back to 22. And again, a little whirlwind tour here. So here is 22, November the 24th was Thanksgiving. And here's the pattern right over here. Buy on the close of trading here, get out on the close of trading here. Couldn't be more simple. Now remember some important things. First of all, there's no telling what the world geopolitical situation is going to be come November of this year. For all we know, none of us might be here. So that's going to open the mind to a lot of psychological torture. Should I take the trade? Shouldn't I take the trade? Is it going to happen? What about the war? What about this? What about that? Don't take any of that into consideration, because that's the part we can't control. Let's only talk about the part we can control, which is the entry, the exit, and the risk. If you control the risk and you feel you've done the research on the pattern, that's all you need to do. It's really very, very simple. Additional trades coming up this year: New Year's Day, day before New Year's, Christmas. I believe there's a couple of more besides that. You might want to refer to the previous recording where I showed the calendar. And again, very specific, simple strategy. But let me ask you another question. And that's the what if question. What I like to call spread of effect. That's EFFECT, spread of effect. Question is this. If you look at this trade right over here, the one in 2022, you'll notice that something interesting happened before that. In fact, let me get a little arrow here and show it to you. Observe. From here to here is a vast expanse of thousands of dollars in potential profit. The what if question is this. What if there was a pattern that got us in sooner? What if this was the actually end of a previous pattern, whereas the pattern actually began here? We have noticed that so-called spread of effect with many of these seasonals that tend to start going higher sooner. Example, let me show you. Let's talk about the indigenous peoples trade that just happened. I'm going to go back to where we were at the beginning of the trade. Just one moment, please. And by the way, if any of you have questions, don't hesitate to contact me at the foundation and I'll be glad to answer your questions. So let's take a look at this. Here is the trade that we are in right now, that we just did. Let me remove everything here, except for the holiday, which is right here. The question I'm asking is this. Is it possible that this holiday actually represented the end of a trade as opposed to beginning of a trade? What if the trade actually started all the way back here? Look at how much money we're potentially leaving on the table. Just to give you an idea, if you don't already know, we're looking here at a huge potential profit per contract. So this ain't hay, folks. The question is, how can we find this? The answer, real simple, seasonal trader. We're going to go there right now. So we go to seasonal trader, and we're going to do a little research. Now, I'm no Einstein, but remember what Einstein said. He said, research is what I'm doing when I don't know what I'm doing. So that's what we're going to do here. We're going to go to a search. For example, let's go to the S&P 500. And we're going to go to the month of November because we want to see, is there anything that comes before the end of November historically that might have greater profit potential than that simple one-day overnight trade. So we're going to go like this. I'm going to say, show me everything you have in your database of seasonals that has been accurate 70% of the time or more. Now let's put it in perspective. We know for a fact that most traders can't be right more than 50% of the time, in fact less than that, and that even when they're given high probability statistics like this, they simply find a way to make it not work. We're not going to do that. We're going to start from a strong base of 70% and we're going to believe in it in terms of certain specific metrics, which I'm going to show you. But before we do anything else, let's do the search. I'm going to say, show me trades that have an actual stop. In other words, I don't want to risk 100%. I want to risk something less than 100%. So I'm going to choose 99 and say, search the entire database, which is vast, which has trillions of trades, and show me anything that has a pattern that is repeatable in terms of high probability. So we're going to go here and do a search. Computer is very happy. It's found a lot of stuff. In fact, it has found, if you can see that on the right, 87 pages of trades. Now, certainly, that presents another formidable problem. How do you choose? Fortunately, the computer has been programmed to put the best trade in the first position. But let's be pragmatic about it and let's be objective about it. What does that mean? The best trade. Best for what? Best profit? Best percentage accuracy? What does it mean? We're going to take a look. The computer has put the highest probability trade on the top of the screen right over here, and that is 88%. However, you'll notice it's a 4-day trade. It gets in on November 2nd, gets out on November the 6th, just 4 days. But that doesn't really capture the essence of what we want to do. What we want to do is find a trade that's longer than that, because remember, no matter what you trade, the longer you're in that trade, assuming of course it's not a losing position to begin with, the longer you're in that position, the more likely it is you'll make a lot more money, because the length of the trade is directly proportional to the profitability in a winning trade. In other words, not a trade that's already in a loss. And we have Warren Buffett to prove that for certain, because he's certainly a long-term trader. So let's take a look and see what we can do. We're going to go and find a longer period of time. That's easy to do. Let me show you what I mean. I go back to the search and I say, I want trades that are at least X number of days in length. So again, through the power of the computer, days in trade, I want at least 25 days in the trade, which will give me an opportunity to capture that move before Thanksgiving, if it indeed exists. So we're doing some research here. I'm going to say, let's see what happens. And now we have something here again. But it persists in finding this date over here because it's less than a certain amount. So that's all right. We're going to go back. And again, I'm showing you how we do the research. And say, okay, more than X number of days, but less than X number of days. I'm going to say, I want something that's more than 10 days. And again, I'm just picking numbers at random here because after all, this is excusable as research. And I'm going to have something here that's at least 35 days. I'm going to give myself a wide brush stroke here. Give the market an opportunity to give me what I want, or what I'm looking at. Here we go. Now we've got something more interesting. November the 20th, which comes before Thanksgiving, through December the 5th. So it encompasses previous to this trade and subsequent to the trade, and has a probability of 85%. That's very impressive. We have other statistics. The average profit in points, the average loss in points, average profit percent, average loss percent. Take a look at this right over here. The average winning percent on the winning trades is 2.39. The average losing trades is 0.86. A very favorable ratio. Let's take a look at the history and keep this in perspective. Please remember, most traders don't follow this process. Why? First of all, they don't even know it exists. Second of all, they don't have the data. And third, they don't care. They don't want to see what it was like in the past. They'd rather be ignorant and happy in the present. I'd rather be happy and not ignorant in neither of those two situations. So here's the history. Again, going back 27 years. And let's take a look at the performance statistics. One moment, please. I'm going to scroll down a little bit and look at it. So this is a very interesting trade. But I'm not happy, and I'll tell you why I'm not happy. Even though we've had some very big winning trades here, and even though it's been persistent and consistent, I don't like this. I don't even want to see anything like that on my performance report, even though the cumulative profit is very nice. I'm still not happy with that. How can I get rid of that? Easy. Let's go back to the search, like so. A moment, please. And say, let's do this. Let's sort for the smallest average loss. We'll sort like this, and like this. And now we have the smallest average loss. Now, we have sacrificed accuracy. We've come down in accuracy, but we still have less potential risk. We still have the dates that encompass the Thanksgiving Day pre-holiday trade. Let's look at it visually in terms of the history. Like so. and ask the question, what does the performance look like again? We don't want that kind of big loss because it's scary and it'll make you make decisions you don't want to make in terms of methodology. You make mistakes in terms of psychology, and making the psychological mistake is much worse. So here you go. Let's look. Aha! Now this is something that I can live with more effectively, and I'm willing to sacrifice the percentage probability for the lower risk. That's an individual choice. You can go back and resort for all sorts of metrics. So example, let's go back to the previous screen, like so. And we can say, excuse me, what about stop percent? Can we sort for stop percent? Can we sort for other metrics? We certainly can, because that will help us understand better. Let's go back now and do something else. Now remember, this was what we were looking at in terms of the futures. Was there a more extensive history in terms of the stock? Because remember, we're only going back about 25 or 30 years here. That's easy to do. Let's go back here to the search, like so. And let's go to the stock section. One moment, please. Seasonal trades, US stock trades. Okay. Let's go to S&P. So remember, what I'm showing you now is the November holiday trade that has not come up yet. For those of you who didn't do the Columbus Day trade or the Indigenous Peoples trade, you'll have another opportunity to not do the Thanksgiving Day trade, or or to do it as the case may be. Let's go to S&P. And please pardon the voice, it's allergy season here in California. Go to S&P 500, which has a longer history. One moment, please. Let's check it. And let's do the same thing, month of November. So remember, the difference here is we're now doing the stock as opposed to the futures. I'm going to take nothing less than 70%. So we're going to use the exact same parameters, like so. We're going to use more than 10 days and less than 30 days. Was it 35 days, I believe? Like so. So what's the difference in what we're doing? We're doing the same thing, except we're using the stock instead of the futures. So here we go. Got something interesting here. So let's take a look at what we've got. We're going to do it. We're going to look at it on the stock, and these are the results from the stock. And remember, we've got more history here. And in this case, the average percent profit is bigger than the average percent loss. So it meets that criteria, because I want to win more money when I'm winning than I lose when I'm losing. Let's look at the history. And remember, we should see a lot more history here. And even with a lot more history, it's 79% accuracy. It's truly phenomenal, considering the fact that most traders are happy with 60% if they can get it. And even then, they'll find a way to screw it up. Sorry about that, folks. Let's go to the history, like so. And we are now looking at 64 years of history. Quite impressive. And in all of this, remember, this is all educational. I'm not giving you advice. I'm not telling you what to do. I'm simply doing some research. I'm no Albert Einstein, but I do know how to do some research. Here we go. And there we are. So, if this chart does not give you the warm fuzzy because of this right over here, or because of this seemingly erratic behavior for the last few years, no problem. We can fix that. We'll just go back in time and resort the data and find something that's more appropriate. And remember, what's going to change is the percentage risk that you're willing to take. What's going to change is the average profit, average loss, the ratio between the two. You have to find something that's within your comfort level, because you're not a machine. You don't have unlimited funds. So let's do this. Let's go back and sort now for the smallest average loss right over here. average percent loss. Resort the data, and then we have the smallest average percent loss. You'll notice this percentage accuracy has come down to 70%, but I can live with that. Let's look at the history. That's the most important part. You don't want to trade. First rule of trading, don't trade anything that scares you. That's not a good idea. So we've got our same 64 years. We've got our entry date and our exit date. Entry date November the 20th, before Thanksgiving, of course. Exit date December the 2nd. And the history, again, much more palatable, a lot less erratic behavior. So this is the trade that I would take. Even though I'm sacrificing the accuracy, I'm still getting less risk, because trading is all about managing risk. It's that simple. Very, very simple. Now let's do something else. As long as we're here, let's take a look at the December trade pre-Christmas. How are we going to do that? Same process. Oh, by the way, one more thing I wanted to show you before I forget. And I hope you're learning a lot from these sessions. I'm going to go back here and look at the seasonal chart, because that will tell me a lot, and I'll show you exactly what I mean. Here we go. Seasonal chart coming right up. And here we go. So what does this chart mean? What does it tell me? The yellow portion here tells me the time frame during which this trade is active. In other words, approximately the beginning of November until approximately the beginning of December. The question is, what happens when it's over? The answer is it dips down a little bit and then comes back up to end toward the high of the year. So that's what's important about this. It tells you there's consistency, and it gives you direction and says you may take some of the profit when the trade is over, assuming there is a profit, but in addition to that, you may want to hold it because there's further upside likely after the trade is officially over. Let's do one more thing and then you'll be rid of me. Let's go back here and ask the same question, return to search, but this time we're going to ask it for December. In other words, is there anything that starts in December before Christmas, before the Christmas Day trade, and runs longer? So we're going to do that very simply. And one more thing, you can do this on any seasonal software that has the capability of maintaining this vast historical database. And that's certainly very easy to do these days. Let's go to December. Come on, computer, cooperate with me. Here we go. And let's see what happens. Again, same parameters, and do a search. We've got something. We've got December 17th to January the 7th. And again, what this proves to me is there is a spread of effect. In other words, the market usually begins to go up not just the day before the holiday, but several weeks before the holiday. Let's look at the history again and ask yourself the question, who does this? Who looks at so much history? Most people don't. But for me, it's all about the history. 64 years. And let's look at the equity curve. Moment, please. Equity curve. And again, I see this nasty little thing here that I don't like. I can get rid of that by sacrificing some of the accuracy for less risk. I do that simply like so. And go here and say, show me the smallest average loss. So I resort the columns like so. And that's the smallest average percent loss right over here. And let's look at this trade. It's still at 70% accuracy. And let's take a look at it. I hope I haven't been boring you guys too much today. But this is really, research can be pretty boring. Come on, computer. Here we go. And there's the trade. Okay, in recent years it's been okay. It had some rough sailing over here, but overall it's been a very positive growth curve. It looks pretty good to me. And if you guys like this kind of information, let me know. In the next episode, what I'd like to do is show how the relationship between one-day intraday behavior relates to seasonality on a bigger scale. In other words, if we take a trade like buying 3M on January the 2nd and getting out February the 8th, has there been a relationship between the behavior of prices on an intraday basis and that big seasonal period to the upside? I'll give you specifics on that next time we meet. Thank you again for attending, and again, if you have questions for me, please send them to the foundation and I'll get them answered for you.